Good morning, everyone. Adam Welch here with Insurance Agency Marketing Services. Thank you very much for taking some time out of your Friday morning to join us on this webinar here today. I feel like we've got a great presentation put together for you. We will be taking a look at kind of a new approach here to uncovering some new single premium life opportunities. Not necessarily a new approach, but oftentimes an overlooked approach. We're going to be looking at uncovering new potential single premium life opportunities through conducting policy reviews with any clients you may have with in-force life insurance policies here. So we're going to take a look at the review process and how you, again, can potentially uncover some new opportunities there. Before we get going, do have a couple of brief housekeeping items to keep in mind here as we get moving. First of all, if you do have any questions throughout the course of the presentation, please don't hesitate to type those into the question box on your control panel and send those over. Be glad to stop and take questions as they come through here. Additionally, we will also have a couple of polling questions throughout the webinar. These polling questions really help us gauge the information we're providing you and makes it, or allows us rather, to get the pertinent information you need out to you. So your participation in those polling questions are greatly appreciated. Simple yes or no answers to those questions there. So before we get going into the meat of today's presentation, I want to spend a few moments here first to go through some great services here. I see a number of familiar names on here, but also see a number of new names here. So we want to make sure everyone's well aware of the great services and incentives we have available to you here at IAMS. And we're going to start with some different business builders that we have. We're going to talk about our referred producer program and our marketing reimbursement program. These are great business builders to help put some cash back in your pocket. So the first one here is our referred producer program. This is a great way to really get some extra cash in your pocket. Just like you out in the field, the most qualified lead you can receive is going to be a referral from an existing client or acquaintance, whatever the case may be. But someone referring your name to someone else, that's the highest compliment you can receive and certainly the most qualified lead. So the same holds true for us here at IAMS. If you know of anyone out in the field, an independent agent that would benefit from working with us here at IAMS, we want to encourage you to pass those individuals along to us and make that introduction. And we also want to reward you for making that introduction. So what's going to happen is once that referral contracts with any one of our carriers, one or more, you're going to get a $50 check as a bonus and thank you for that referral. And then once that referral begins doing business, you're going to get a 20 basis point override on that referral's business. So you can see in that example, there's some significant opportunity to earn some great extra cash there in your pocket just by referring some agents over to us. So you can see in that example, you refer over 3 producers and each one is $1 million a year producer, an annuity, single premium life, whatever the case may be. That's going to be a sizable check and $6,000 additional cash in your pocket just for making that introduction. So keep that referred producer program in mind. Let us know if there's anyone you know of out there that would benefit from working with us here at IAMS. Additionally, we have a marketing reimbursement program, and just some rough numbers here. Every $100,000 in annuity or single premium life business you write with us, we're going to set aside $200 in a marketing reimbursement account for you. That is your money to use how you wish, as long as it is geared towards the expenses rather are geared towards building your business and marketing yourself and growing your business. Submit us the receipts, and we will be glad to cut you a check to help reimburse some of those expenses for those marketing needs. So if you do a client seminar or client appreciation event, need new business cards, whatever the case may be, as long as, again, it's geared towards marketing your business and building your business, send us those receipts and we will cut you a check for up to half of those expenses with what you have in that marketing reimbursement account. So again, great business builders putting some cash back in your pocket. Additionally, new producer bonus, new producer builders here. Not necessarily new to the business, but new to us here at IAMS. If you are newly contracted with us and begin writing business and your first 180 days of being contracted with us, we have 3 different levels which you can cash in on for the new producer bonus. Certainly some great perks, as you can see. I'm not going to go through these one by one, but of course the most popular, that $100,000 level, is $750 cash bonus. $300,000 level, that gets a bit sweeter there at a $1,500 gift card. And then some great business building perks there at the $500,000 level. So once you start writing business with us and hit one of those 3 levels, you can cash in at any one of those levels there. So once you hit them. So keep that in mind. New producer bonus, that's available to those of you that are newly contracted with us here at IAMS. And all business written in the first 180 days of being contracted qualifies you towards that new producer bonus. Back office support. We want to be the IMO out there that's going to help you work smarter and not harder. We want to help you work more efficiently out in the field. So as an independent agent, you have a lot falling on your shoulders. You're meeting with clients, you're making sales, you have the admin responsibility, you may not have a team of back office support. Well, we want to be that back office support for you and your business. We want to take that administrative responsibility off of your plate and shift it onto ours. So we have a number of business building tools and resources. Our annuity and life marketing staff will help you with all of the case design assistance and product selection, illustration assistance, so on and so forth. We want to be your service point here from submission to commission, as we like to say. So everything pre-sale, leading up to the sale, to writing the business, you submit it to us and we will take it from there. So you can, again, keep focusing on the things that matter to you, which is meeting with clients, building those relationships, and making sales. Be able to get forms and the quotes out to you, as I've mentioned. And we also have some great expertise here in the marketing staff that can help you with coaching and marketing efforts there. So again, helping you work smarter and not harder, helping you be a bit more efficient there. You may not be aware, but we do have a full service creative department here at IAMS. IAMS Creative Services, Josh and his team do a fantastic job of helping our agents and advisors craft their brand messaging and their logos, and really getting their message out there, getting them in front of more new names. So helping you, again, be more efficient on that marketing front there. So we have a number of solutions ready to go for you on the turnkey solutions. You can see newsletters and flyers all ready to go. We just customize it with your information, and they're ready to send out. Our agency solutions here, again, Josh and his team will work with you to build your brand, build your logo, and get that message out. And then digital solutions, online marketing, your search engine optimization, and social media marketing. That's kind of the direction everything's going right now, and they do a fantastic job of assisting in that area. I will mention we are not in the creative market to make money here. We are going to be very competitively priced, especially compared to perhaps your local advertising or PR firm. We, again, are not in that to make money. We want to help you get your name out there, and we want to be cost effective for you so you can make more sales. That's when we all make money. So again, very competitively priced. If you're in need of any of these solutions, please give Josh a call. He'd be glad to visit with you about what we can do for you and help you out from there. Our website, www.iamsinc.com, a lot of great information available out there. If you've not already registered on our website to be able to log in and access this, please do so today. Get out there at, again, www.iamsinc.com and register. We have our term quoting engine out there. Forms are available on our website. Links to different industry news sources and current industry events out there, as well as our current life, annuity, and LTC product grid, so you can take a look at what's out there right now. So again, great resource for you with our website, iamsinc.com. Retirement Analyzer software. This is a very powerful piece of software here that can be used to illustrate to your clients the power of working with you and implementing your recommendations. So this software does a fantastic job of answering those 6 key questions you see listed at the bottom of the screen there. It really shows them how long their money's going to last without you. And just staying the course with their current standard of living and their current retirement funds. More than likely they're going to be running out of money early in retirement. Well, this really illustrates the power of your recommendation, be it a guaranteed lifetime income annuity, or perhaps the power of life insurance, or the effect of long-term care expenses on someone's retirement income, and show the power of a long-term care policy or hybrid, whatever the case may be. So again, it's a tremendous piece of software there to illustrate your recommendations and actually bring things full circle in a very simplistic, easy to understand way for the client. So Marcus Solar in our office is the point person for the Retirement Analyzer. He'd love the opportunity to visit with you a bit further about what it can do for you and go over the details of how you can access that software and get up and running with it. All right, IAMS Wealth Management. This is going to bring us to our first poll of the day. You may or may not be aware, we have recently launched a registered investment advisory here, and that is IAMS Wealth Management. So not only can we assist you with your annuity and life insurance business, but we can also now get you into the fee-based asset management business. So I'm going to go ahead and launch this first poll. Very simply, would you be interested in learning more about IAMS Wealth Management? This is very powerful side of the business to get in on, and we've structured our RIA in such a way that you're not going to be bogged down with more administrative stuff. Again, we want to shift that from your plate to ours, so you can focus on meeting with clients and gathering assets and building those relationships. So there's a number of reasons why you should add this fee-based asset management to your business model here. Just a few of those. You're going to see an increase in revenue. You're going to get some recurring revenue. So you're not making a sale and earning commission. In this case, you're gathering assets and earning fees on those assets under management. By doing this, you're going to likely see an increase in your fixed index annuity business and insurance business as well, just because you're going to be more of that holistic one-stop advisor for your clients. You're going to be able to help them with more of their needs, not only guaranteed income with the annuities, life insurance protection, but now wealth management and wealth growth as well with IAMS Wealth Management. You're going to improve client retention. Again, offering a full range of products and services, very valuable out there, and it goes a long way towards strengthening client relationships as well. So it looks like a number of you did respond to that. Thank you very much. Those of you that did respond yes, you will actually get a follow-up email from Charles, our hiring, or Mike Hansen, our wealth management department here. They'll get you some additional information and introduce you in a bit more detail to IAMS Wealth Management, see if that's something of interest there. But certainly something to keep in mind, especially the direction things are going in our industry today. So thank you to those of you that responded there. We will get some additional information out to those of you that responded yes. I'm going to go ahead and close that out. We'll keep moving here. All right, this is actually going to bring me to our second poll of the day. So us here at IAMS, or we here at IAMS rather, we are big on training, from our full webinar calendar throughout the month to live in-person trainings with our Life and Annuity Academies. I'm going to go ahead and launch this. Very simply, would you be interested in the Life and Annuity Academy? Before I go further, I will mention clicking yes, certainly not a commitment to attend, but it's just letting us know that you would have some interest in possibly attending and learning about some additional details there, and we'll get some additional information out to you following the webinar today. But these are industry recognized events. These are 2.5-day training meetings. They're all expense paid, so we're going to take care of your flight, hotel, meals, all of that is on us. It's only going to cost you a couple of days out of the field. We know that a couple of days away from your office, away from the field, that's expensive in and of itself. So we want to load you up with as much information as we can and give you some great information to take back to the office from this meeting. So it's not going to be your typical training event where we're going to do a product roadshow from different companies and talk about product A versus product B. This is more geared towards marketing yourself and building your business, giving you ways to get in front of more new people. So we're going to go over a number of different sales ideas and strategies from several of our top producing agents. They will come in and go over what they're doing on a day-to-day basis to build their business to the point that they have today. A number of them still use seminar marketing and have continued to have significant success with seminar marketing. So they will go over exactly what they do with their seminar systems and how they're so effective with that. We'll go over some, of course, different industry threats and trends. Go over how we can help you with large life case marketing. So if you're in the wanting to get into the business owner a product niche, a market niche, if you will, we can talk about what we can do to help you with some of those large, more advanced planning, life case marketing. Wealth transfer, of course, we'll talk about single premium life, and go over some different advanced annuity sales topics, and go over some different software tools that we have available for you, including the retirement analyzer. So we jam pack a lot of information in those 2.5 days. But our hope is that you're going to be able to take one or two pieces of information from that meeting, take it back to the office once you get back there, and implement it right when you get back and see an increase in your business and get you in front of more new people. So again, not going to be your typical product roadshow. We really gear these meetings around marketing and sales so we can help you build your business. So that's our 2-day training, our all expense paid life and annuity academy. We have 2 remaining dates here in 2017. If you haven't yet responded, please click yes there, and we'll be able to get some additional information out to you. You can take a closer look and see if this is something for you. So with that, I'm going to go ahead and close that out. And again, we'll keep us moving. Thank you very much for those of you that participated in that poll. All right, last item I want to talk about before we get into today's presentation, our 2018 IAMS Marketing Summit. It's going to be February 25th through the 28th out in beautiful Scottsdale, Arizona at the Boulders Resort and Spa. Very excited about this trip. Certainly a great reward out there. There's going to be some great information presented as well. So if you'd like details on how you could attend that marketing summit, please give us a call. Let us know, and we can go over the details with you. But should be a fantastic trip, and we're looking forward to next February here. All right, so getting into why we're here today. Friday webinars here with IAMS have really been kind of dedicated to single premium life Fridays, if you will. And today I want to take a little bit of a different take on single premium life Fridays. So I want to talk about kind of an overlooked concept here, which could uncover some tremendous single premium life opportunities, and that's going to be managing policies for new opportunities. So conducting policy reviews and annual client reviews is a way to uncover some new opportunities. So what we're going to talk about today, I'm going to first touch on why conduct annual reviews. What's the benefit? I'm going to talk about why policy management, life insurance policy management to be more specific, is needed more today than ever before. Talk about the policy review, give you some tips and some pieces of information to gather to do a prudent policy review and uncover those needs, those new needs and new opportunities. And then talk about policy remediation, and this is where new opportunities could very well present themselves. All right, before we get into some of those items, just want to kind of recap here, talk about the ideal single premium life prospects. So kind of the low-hanging fruit, if you will, out there. Typically, ideal single premium life prospects are going to be seniors that have assets they don't need for future living expenses any longer. Perhaps they were never earmarked for future living expenses, and more so earmarked as leave behind money. So any funds sitting in traditional, what's thought to be traditional, safe, conservative money accounts. So your CDs, money markets, even overfunded checking and savings accounts. There's a number of folks out there can continually run across it where they have, in some cases, hundreds of thousands of dollars sitting in their checking account, just sitting there and checking. So certainly not always needed to have that much in checking or savings. Oftentimes that those assets can be better positioned elsewhere. Clients with annuities no longer needed for income. Great opportunity to reposition those assets into a legacy type product and remove the tax obligation from beneficiaries. And then brokerage accounts. Senior clients that are may have some brokerage accounts out there, may be exposed to more stocks than fixed income, maybe a little more aggressive than they should be, but this isn't money they're going to need to live on. Again, ideal for a reposition into a legacy type product here. And then secondly, any seniors with in-force life insurance policies. So this is what we're going to talk about today. We, of course, like the CD money market checking savings opportunities that, as I mentioned, is kind of the low-hanging fruit. But if you have any clients that have in-force life insurance policies, you need to be doing reviews on those policies because they're probably not managed appropriately. If they haven't been reviewed on a regular basis, they could be in danger of lapsing potentially, and there could be an opportunity to rescue some of those life insurance policies with single premium life. So perhaps they're older universal life policies that are now imploding. Interest rates where they are now versus where they were in the 90s or even 80s on universal life. These policies could be severely underfunded and in danger of a lapse. This is a way to rescue those policies, rescue that remaining cash value, and transfer it into a paid-up single premium life plan. Older whole life policies that may be paid up or close to paid up. Maybe they were issued many years ago and they're scheduled to be paid up at age 65 or 70, whatever the case may be. A lot of times, taking that cash value and moving it into a single premium life policy is a way to still provide them a paid-up policy, but at a higher death benefit amount than what would be paid up had they stayed with that older whole life policy. So I know a lot of times you're thinking, well, if policy is going to be paid up, why do anything with it? Just let it go. It's paid up. Well, this is a way to potentially get them a higher death benefit with that paid up cash value, that paid up policy. Then any cash value policy that's now become unaffordable. Premiums are no longer affordable. Maybe the policy is no longer needed. The full death benefit is no longer needed. Is certainly an opportunity to salvage that cash value in that policy for single premium life. So just, again, kind of recap some ideal SPL prospects there. So why conduct annual client reviews? You're probably hear us say it a lot, and you very well, in all honesty, may get sick of us saying it. You may hear it all the time, but we really are big advocates here at IAMS of conducting annual reviews. If you've been in the business for a number of years, chances are you're going to have a pretty good book of business there to go back and keep in regular contact. There's a number of reasons here. It's just good customer service first and foremost. Make sure the recommendations you've made and put in place are keeping up with the current needs. Needs change, life happens, so make sure that those recommendations are keeping up with current needs. It's going to keep you in regular contact with your clients. You're not just making the sale and then disappearing. You're going to stay in front of your contacts. It's going to keep building and strengthening that relationship so your clients view you as a trusted advisor. They'll come to you when additional needs arise, maybe off schedule from their annual review time. It's an opportunity to update or rather have your client update you on life-changing events. Maybe clients got married or had children, have grandchildren. Perhaps there's a divorce that's taken place. Any of those life-changing events very well could signal a change in insurance needs. So it's a way to update existing insurance, way to identify any additional insurance needs and identify a new sale opportunity there. So again, keeping regular client contact, gives you that chance to update on any of their life-changing events and stay in front of any new sales opportunities, and get that business to you versus the next guy. And then, of course, it's an opportunity to review any in-force insurance coverage and manage that prudently, so it's going to be there when they need it most. And then finally, referrals. Referrals. I can't say it enough. Our RPM program, I had mentioned, referrals are the most qualified lead. Anytime you're in front of an existing client is a time where you can ask them for referrals. Mrs. Client, are you satisfied with what we've put in place? Are you satisfied with the service you're receiving from me? Great, I'm glad to hear that. Who in your network may benefit from working from me? Who can I explain what I do, the type of business I do, and how I can assist them? It's a great way to ask for referrals there anytime you're in front of an existing client. So why policy management is needed today? And it's really needed today more than ever before. Innovation is a great thing, but innovation in the life insurance industry has led to some more complicated products. There's a lot more bells and whistles out there and a lot of different strategies and features associated with life insurance, but a lot of times that's going to lead to more complicated products that the average everyday consumer is not going to necessarily understand. It shouldn't expect them to. You're the professional, so they look to you. So managing those products, and if there's a lot more moving parts, it's definitely going to necessitate some additional oversight. It's going to give you an opportunity to monitor performance of that policy. So if interest rates are fluctuating, maybe COIs are fluctuating inside that policy, that's going to affect the policy's performance and the performance of the cash value. Doing annual reviews and managing that policy is an opportunity to keep an eye on that performance and make sure it's performing adequately. It's going to give you the opportunity to monitor the adequacy of policy funding. So again, going back to the cash value performance, making sure premiums are keeping up with the internal cost of that policy and the crediting rates associated with that policy. And today, again, with all the innovation, life insurance is no longer just insurance. Oftentimes, life insurance is sold as part of a strategy. It's sold as an alternative asset class, to fund a partially tax-free retirement, or to help fund a child's college expenses. So it's no longer just death benefit protection, no longer just insurance. Oftentimes, there's going to be a strategy associated with the life policy, which just necessitates that ongoing oversight and management even more. And then, of course, gives you a chance to review carrier stability and make sure the carrier is going to be able to pay claims as they have promised, and make sure they're going to be able to make good on their promise when the clients really need it most. So I want to take a look at kind of the evolution of life insurance, and this graphic here is not meant to be kind of chronological in how life insurance was developed, but more so is a representation of over the years with the innovation, how innovation has actually really transferred more of the risk of keeping that life insurance policy in force from the insurance company to the policy owner. So starting out whole life, kind of the oldest form of insurance, the most basic form of insurance. You pay the premiums, that death benefit's guaranteed to be there as long as those premiums are paid. The responsibility of managing the investment accounts, so the insurance company can continue crediting to the cash value and continue paying dividends if it's a participating policy. All that responsibility fell on the insurance company's shoulders, not the policy owner. Policy owner just had to make sure that those premiums were paid in full and on time to keep that policy there. Fast forward a little bit, and we have the development of universal life. So this started transferring some of the risk from the insurance company to the policy owner. Universal life was brought about to provide greater flexibility. So you now have the flexibility to adjust the death benefit, to adjust premium payments. If you wanted to pay more, you certainly could, up to, of course, premium limits, premium guideline limits. If you ran across financial hardship and couldn't make the full premium payment or couldn't make a premium payment at all, well, as long as there was enough cash value to cover the cost with that policy, yeah, you could skip that premium payment and the policy would still be in force. So with that flexibility, there's some interest rates associated with it. You have the crediting rates with universal life. You're going to have, in many cases, a current crediting rate and a guaranteed rate. Well, it's still up to the insurance company to manage their underlying investments appropriately so they can continue those crediting rates with the universal life policy. But if for some reason something happened and they couldn't keep up those projected crediting rates and they have to drop them down, well, that cash value accumulation is not earning as much interest, so it's not growing as much and not able to keep pace with the costs of that policy. Perhaps the client's going to have to pay more, so transferring a bit more risk onto the client's shoulders and off the shoulders of the insurance company. Then you bring into the mix index universal life and variable universal life. Same concept. You have a bit more power and control over how the interest is going to be credited to the cash value of that policy. Again, removing that responsibility from the insurance company to the policy owner to make sure those cash value accounts are going to grow appropriately to help cover those expenses. If they don't, then the policy owner is going to have to shell out some more out-of-pocket funding to keep those policies in force. So again, not a chronological depiction of the evolution of life insurance, but more so just a graphic showing the transition of risk from the insurance company to the policy owner with today's life insurance products. So getting into the policy review here, there are really four key categories we want to take a look at with each policy review. And really we're going to focus more on your permanent plans, so your universal life and whole life products. So we want to take a look with every policy. We want to take a look at the policy funding. So here we're looking at the amount of premiums that are being paid out of pocket and the method of those premium payments. So make sure that policy funding is adequate. Of course, we want to look at policy performance. We want to look at how the cash value accumulation is growing. We want to look at the charges and fees, disclosed in the annual statement and the actual policy contract itself. Make sure performance is staying in line. That kind of goes hand in hand with the policy funding there. And then thirdly, we want to look at policy loans. If there's any loans existing on the in-force plan, we want to take a look at how big they are and what their overall impact of the policy may be. And then, of course, carrier stability. Want to make sure ratings are acceptable, risk-based capital. It goes further than ratings, but making sure that the claims paying ability of the carrier is still there, and making sure it's with a reputable, financially stable company. So first step in conducting a proven policy review here, we've got to obtain some data. What I have here, just kind of a breakdown. Again, we're going to be focusing more on the permanent side of insurance here with universal life and whole life. So we can see the different columns here, some different pieces of data we can order from the insurance company or from the client that they likely already have. So I have starred those top two, the annual statement and an in-force illustration. At the bare minimum, this is what's going to be needed to conduct the review. So your client's going to have an annual statement, should at least. If not, can certainly get that from the insurance company. And then a current in-force illustration. So here we want to look at how the policy is performing today under the current assumptions. So what premium payments are currently being paid and what are the current interest rates or dividend scales. So we want to get a glimpse at how that policy is performing today and projected to perform in the future under those current scenarios. Bare minimum, that's what we need to take a look and review the policy and look at those four key review categories. In addition to that, some alternate funding illustrations can certainly be helpful. So universal life, we could certainly order an additional illustration showing suspended pay. So we are suspending all premiums. We're not going to pay any more. We want to see how long that insurance coverage is going to last with no additional funding. And then on the other side of that, if the policy is projected to lapse prior to maturity under its current funding scenario, or even if it's projected to mature under the current funding scenario, we want to take a look at the minimum premium to carry the policy to maturity. So looking at possibly a more efficient use of premium payments and perhaps an overfunded situation there. So with that, that's going to give us a nice range of options here. We're going to have the current funding, current scenario, okay, and then we're going to have suspended funding showing what happens with no further premiums being paid, and then we're going to have a scenario showing what's needed to keep that policy in force to maturity. Those three items are going to allow you to have a conversation with your clients a heck of a lot easier, be able to say, okay, well, here's where we're at today. If you're no longer willing or able to pay premiums, here's what's going to happen. The other side, if you're willing to increase funding if needed, here's what's going to be needed to keep that policy in force to maturity. A similar story on the whole life side. While premiums are always going to be due with whole life, as opposed to universal life, where premiums really aren't actually due, generally speaking, there's a billed premium, but it doesn't have to be paid to keep that policy in force as long as there's cash value. Whole life, those premiums have to be paid, and they're going to be paid one way or the other. Either they're going to be paid out of pocket by your client, or they're going to be paid partially by dividends, or perhaps even by premium loans. So we want to see, again, the current funding, how premiums are currently being paid. And then we want to, if possible, look at a suspended outlay. So perhaps switching the dividend option to using those dividends to pay premiums, or perhaps even using an automatic premium loan to pay premiums. So that suspended outlay, suspended out of your client's pocket funding scenario. And then I'd already mentioned the alternate dividend use. See if there's a more efficient use of those dividends within the policy. So those are some key pieces of data to obtain from the carrier and or client to complete the policy review. Once you have that data in hand, we're going to take a look at what we're actually looking for with that data. So universal life policies, we're going to zero in on here real quick. We want to look at the funding and do a review of the funding, as I had mentioned before. So we want to identify if this policy is underfunded, meaning it's projected to lapse prior to maturity on that current scenario illustration. Is it adequately funded? It's projected to stay in force to maturity or desired age. A lot of times today with new mortality tables that run out to 121, age 121, new universal life policies are going to be scheduled to mature at age 121 or 120. Maybe a little bit overkill. There's been a lot of advances in medicine, but I don't think anyone has made it that far yet. So, perhaps structuring the policy to stay in force to age 105, where the survival probability is virtually zero, is sufficient. So we want to look at if the policy's projected to remain in force to maturity or to age 105 or whatever desired age you agreed on with your client. We would define that as adequately funded. Is the policy overfunded? So are we in a universal life policy where we're paying too much for that coverage, perhaps? Now, of course, if we're in a situation where this policy is part of a tax-free retirement plan, yeah, we want to overfund that. We want to accumulate as much cash as possible. But if we're looking more at a pure death benefit protection case here, are we paying more than we need to for that level of death benefit coverage? So perhaps funding the premiums could be reduced on that policy and still maintain its coverage to maturity or the desired age. And then we want to look at the performance review. So performance and funding really kind of go hand in hand, but when we're looking at performance, we're kind of shifting our focus to how that cash value accumulation account is growing. If it's a current assumption UL, a fixed UL, what are the crediting rates doing? Are they in line with what was originally proposed at the time of sale, or have they dropped? Have they increased? In IUL, take a look at the cap rates. Same deal. Have the cap rates dropped or increased? And then what was the performance? How did the index perform in that particular index strategy? And then participation rates as well. There are some participating universal life policies out there, so taking a look at the dividend scales with those participating policies rather, and of course participation rates on IULs if it's an uncapped strategy. So again, looking at changes from policy issue, and then again changes from the prior review. We want to look at the cost of insurance. This is sometimes difficult to identify what's happening with the internal COI and the internal costs associated with that policy. But if the crediting rates have remained the same and there's premiums have remained the same, they've been paid on schedule, and cash values off from what was projected the prior year with no changes in those crediting rates or premium, likely there is maybe a bit of an increase in the COI. Now, if a carrier is going to increase cost of insurance beyond a certain amount, they do need to send out notice to the clients. And I can think of, let's see here, 3 or 4 well-named, kind of big brand name, if you will, carriers that have in the recent, I'll say, 2 or 3 years, come out with some sizable increases in their cost of insurance rates. That it really had a huge impact on the block of policies that they increased those COIs on. So that's a significant thing to keep an eye on, is insurance companies, general account performance has suffered with our, what seems to be a perpetual low interest rate environment right now, is those general accounts have suffered with the performance of those investments. They've got to make up the ground somewhere, and several of them made the decision to significantly increase COIs. So again, that has a huge impact on performance if the crediting rates are remaining unchanged or even dropping with that increase in COI. So taking a look at the fees and expenses is a big part of the performance review as well. And then, of course, policy loans, as mentioned earlier, we want to take a look at any existing loans. How big are they growing? Is interest being repaid, or is it just being allowed to recapitalize and let that loan balance grow? What's the effect on the policy? Similar story here on the whole life side. So just as with universal life, with whole life, we want to take a look at the funding review. And again, we already know that whole life policies, those premiums have to be paid. It's just a matter of how they're being paid. So is the policy underfunded? Perhaps a whole life policy has a term rider, or it's a term whole life blend. And that cost associated with the term policy is increasing. That's going to necessitate some increased out-of-pocket funding from the client to make up that shortfall in the increasing term cost. Again, if there's a loan outstanding, the loan's starting to grow as large as the cash value, well, we're going to have to start increasing out-of-pocket funding to repay some of that loan and keep the policy in force and avoid an equity surrender. Is the policy adequately funded? It's performing as projected. Premiums are remaining the same. No changes in outlay are projected there. So those are the really 2 main funding areas to take a look at with whole life policies. And then, of course, performance review, where universal life, we had the crediting rates and index rates associated with them. Depending on the type of policy, whole life, we want to look at the dividends. So if it's a participating whole life policy, take a look at the dividend scales and how those dividends are being used. Again, talking about the term riders, this can really kind of turn into a time bomb on whole life policies. If there's term riders associated with them, those costs increase each year the client ages. So take a look at the expiration. If that term rider is going to fall off at a scheduled date, what's that going to do to the total death benefit coverage? And then take a look at the associated costs with maintaining that term. And then again, loans, taking a look at the overall impact on the policy. So those are the key areas to look at with permanent life insurance. And quickly, if there's some term coverage, out there with your clients that you're taking a look at, there are some key review categories to take a look at here with term. This really wouldn't identify a potential single premium life situation here with term, as there's no cash value. But since we're on the topic of policy review, wanted to touch on this as well. So we want to take a look at the premium competitiveness. We can run a quick quote here and see how competitive premiums are at the current underwriting class with some other carriers. See if it's in line. Maybe it may make sense to drop that old term and go into a new term if the client is still insurable. Level premium guarantee period, the actual term period. Where are we at within that level premium guarantee? Or do we still have a number of years to go, or are we nearing the end of that term? If it's a 15-year and we're in year 13, probably time to start having a conversation about whether or not that coverage is still needed. Do we need to look at a new plan, or maybe a different type of plan altogether? And then conversion privileges. Does the term product have rights to convert that policy to a permanent plan? If so, when does that conversion privilege expire? And then that should be a deadline there for you to at least get together with your client during that term and discuss whether or not conversion would make sense. Do we still need that coverage? If so, let's look at converting that. Almost all the time you can convert it without proving insurability. So certainly beneficial there. I always like to say, term has a great place out there for young, healthy folks. It's a way to lock in their health today, very cost efficient, get some coverage, and then down the road, they're going to have their insurability. They're going to have their health locked in, so they can look at converting that down the road, maybe as careers progress. So, and the premium affordability increases. So a great way to kind of bridge the gap there, pardon me, as they get going in their careers and can, down the road, maybe, 5 or 10 years down the road, be able to afford a permanent policy to stay in place. So they've locked in their health when they were young. So taking a look at the conversion privilege again, just a quick rundown of what to look for with term policies if you do have clients with enforced term. So the findings. We've gathered the information. So we have the annual statement, the current in-force illustration, and perhaps our alternate funding illustrations. We've taken a look at all that. What are our findings? So there's a few different ways that the review could identify a troubled policy or problematic policy. If the policy is underfunded, that means there's going to be an untimely lapse. It's going to lapse prior to maturity, perhaps even prior to life expectancy. So, we're paying the premiums for something that's not going to be there when we need it. Definitely would identify an opportunity to remediate that policy, which means a new opportunity for you, more than likely. Is a policy overfunded? Perhaps there's a more efficient use of the funds. Maybe we can back the funding down and use the excess funds in maybe an annuity, or if you're an advisor with Hines Wealth, maybe reposition that into a managed account. Whatever the case may be, whatever would be suitable, that could certainly open the door to a new sales opportunity there. If the policy is underperforming competitive plans, so maybe the policy is still projected to stay in force through maturity, but running a comparison with something available today, there's more cash value accumulation than the in-force plan, or we can get the same coverage for lower premiums with the in-force plan. Well, that's going to tell us that the costs, the internal costs, COIs and policy fees, are not really competitive with what's out there for sale today. So taking a look at that underperformance and perhaps non-competitive policy. COIs, kind of going hand in hand here with the competitiveness. COIs are excessive compared to other similar policies out there. If the data you gathered and your review of that data identifies a troubled policy, then you should start discussing remediation options and how to remediate that problem with that life insurance policy. So some different remediation options out there. They can vary by base plan, of course, but generally, these kind of hone in on universal life here. Generally available options are going to be to increase the funding if there's an untimely lapse, decrease the face amount within tax compliant constraints. There could be a way to bring that funding to a more adequate level. As long as that full death benefit isn't needed, you can decrease it to a more suitable level. You can do a combination of 1 and 2. So increase the funding, decrease the face amount, and meet in the middle there. 4, you can explore 1035 exchange. And this is really where some single premium life opportunities can come into play. If there's an underfunded universal life policy, so as we talked before, the crediting rates have decreased since issue, and the cash value is, the policy is basically cannibalizing itself. The cash value is dropping down with the costs associated with the policy. The premiums are no longer sufficient. Client can't increase funding. They just want to let it go. Well, this is a way, and let the policy lapse. This is a way to salvage that remaining cash value and rescue that policy, rescue that cash value, and 1035 it into a single premium life policy. We'll have a couple of case studies here at the end that we'll talk a bit more about that here in just a moment. But this is really where you can uncover some single premium life options here. And then, of course, you could consider a cash surrender. It certainly can be suitable, but why surrender that cash value when more than likely you're going to be able to purchase a paid up plan, depending on the cash value that's in there, through a 1035 exchange. Regardless of the option that's selected here, suitability and needs analysis definitely should be completed. So if there's a problematic policy, you're talking about remediation options, the first step in that process should be updating the fact finder and doing that needs analysis. How much insurance coverage is needed? Do we need less, or could we get away with less, or do we need more? So identifying the needs is definitely going to be a recommended first step. So taking a look at our first case study here, you can see here in the top left, we have our scenario here, a 67-year-old male. He's in a fixed current assumption universal life policy. Current face amount on that policy is $1.2 million. We're paying $23,000, about $23,000 a year in premium there. We ordered the information, the illustrations from the company. We have the annual statement, and we have everything we need to complete the review. And our findings from that review and that data, we see that the crediting rate has changed. There's been a large decrease. This is an older policy that was issued back in the 90s, and the crediting rate has since decreased, and it's actually down to its guaranteed minimum, which is not what the premiums were projected based on. So the policy, as I mentioned earlier, is cannibalizing itself in this scenario here. Crediting rates decrease, funding is no longer sufficient to keep up with the charges. The growth is no longer sufficient to keep up with those charges, rather. So it's kind of self-imploding. So the cash value is dropping rapidly, and the policy is projected to lapse. Keep the policy in force, but the client would have to pay more premiums out of pocket to keep that policy in force and avoid that untimely lapse. So a solution here, this is certainly a prime example here of a great way to rescue a universal life policy from itself, really. So you went through and did your due diligence as a fiduciary and did that needs analysis. Found that that $1.2 million face amount was no longer needed. Maybe there was a drop in the estate liability, the total estate for the insured, and didn't need that full face amount. You could get away with a lower face amount, and the owner, really was not interested in paying those increased premiums to keep that full $1.2 million in force to maturity. So here, recommended 1035 exchange, take that remaining cash value before the policy lapses. You paid those $23,000 a year in premiums for several years, and now the policy is going to run out of gas and it's going to lapse, and you're going to have nothing to show for those years of premium payments at $23,000. So you're rescuing that remaining cash value. 1035 exchanging it into a single premium life policy, you're going to accomplish a number of things, one of which it's going to be a paid up plan. These single premium life plans are guaranteed to stay in force to maturity. They're never going to get a premium notice saying you need to pay more, the cash value is insufficient. It's a guaranteed product. So it's a paid up plan. They're not going to have to worry about forking over any more cash to an insurance company. And it's, again, going to be a more appropriate level of coverage. Well, that cash value didn't get us the $1.2 million. Needs analysis identified that wasn't really necessary, so we got a more appropriate level of coverage. So that is really an ideal scenario there, and honestly an all too common scenario where the clients have these policies and they see they're going to lapse and they're just going to let them go. This is why you need to be out in front of them doing annual reviews to identify that lapse and present them with an alternative. Second case study, here to spend just a couple minutes. We're coming up on our time here. So second case study, taking a look at the scenario in the upper left-hand corner, we have a 72-year-old female. This policy is a whole life term blend. So it's not all whole life coverage where it's all guaranteed as long as premiums are paid. A portion of that $500,000 death benefit, actually a large portion, is made up of term coverage. Premium for this, because of the term, it's more cost effective than paying premiums for a $500,000 whole life policy. Premiums are $9,500 a year. All right. Well, we ordered our illustrations and policy data, and we've identified that it looks like those premiums for the term portion of coverage are increasing. So, we have a 72-year-old female that term coverage is getting pretty expensive and it's becoming cost prohibitive. In addition to that, the insurance company is compounding things by reducing their dividend scale. Their investment account may be suffering a bit, not able to pay the full dividends. Maybe they paid out more claims than anticipated. Whatever the case may be, that dividend scale was pulled back, and a portion of those dividends were being used to pay that $9,500 premium. So with that, we're going to have to increase out-of-pocket funding or take policy loans, neither of which is attractive to the client. So because the owner is not willing to pay the additional out-of-pocket premiums and increase the premiums to maintain that coverage, we again look at salvaging that remaining cash value and doing another 1035 exchange into a single premium life plan. So again, you're going to get a guaranteed policy. It's paid up. No additional premiums are going to be due to keep that policy in force. And another great feature of single premium life are the accelerated benefits. So here we have a 72-year-old female, no existing long-term care coverage in place, getting concerned about the need for long-term care. She's healthy now, but what if things change? So in this case, we're getting her a pretty generous benefit with some accelerated benefits for long-term care coverage. She's not paying the high premiums for a standalone plan. We've got a guaranteed life insurance policy. The death benefit's going to pass income tax-free to beneficiaries if she doesn't need to use that for long-term care events down the road. So again, doing the needs analysis, doing a review of the in-force policy can certainly lead to new SPL opportunities, and not just SPL, but can certainly lead to some other opportunities as well. So went through that a little quickly here, but we are coming up on our time. Do have a couple of questions. Looks like one question that came through asking about, looks like we were going back to the kind of competitive analysis and looking at what companies and products are the strongest. And, there are certainly some strong companies out there with very strong products. It's all going to depend on the scenario, the client, age of the client, health status, and what we're trying to accomplish. Unfortunately, as we talked about with the evolution of life insurance, It's not quite as simple as saying, this is the best product now, and that's a blanket solution. It's all going to come down to what the client's needs are and what the client's current situation is, and what we're trying to accomplish. So there are a number of competitive plans out there, but a competitive plan in one situation may be really not the ideal situation for someone else. So good question, though. It's just not quite as black and white as I know we all wish it would be. So with that, I do thank everyone for joining us here. Again, we covered that pretty quick, but again, the main takeaway here that I want you to take away from this presentation is we know the ideal situations of repositioning CD money or money market accounts or even annuities into single premium life if they're no longer needed for income. But another great opportunity to uncover those single premium life is doing a policy review, doing a proven policy review. And I can't guarantee it, but I feel very confident that you're going to come across some nice single premium life opportunities by doing those policy reviews. And over and above, a policy review is just flat out good customer service. So with that, I do thank everyone for your time. I'll be touching base with everyone individually here. And following up, be glad to visit with you a bit further about what was presented here and how to conduct a policy review. So with that, I'm going to go ahead and wrap up. I hope you all have a fantastic Friday, great weekend, and we will be in touch soon. Thank you.